Welcome to the trading room. This is Rob Reinhold. I'm joined by Darren Fisher and Mavericks. We'd love to see here, and I cannot believe that August is already done. We're going into September this week. And remember, we talked about this last week. September is the worst month of the year historically, and the most crashes have happened in September. And we talked about this last week, saying we are running headlong into seasonality patterns and to be cautious. So let's talk about what happened in last week's market, because it was a tale of really just individual days. On Monday, we had a big down day, down 2%, market looked terrible. And then all of a sudden, Tuesday through Thursday, we found some support. And Thursday, we had this huge end of day rally where the markets were up 1.5% to 2%. And everything was looking pretty good until we heard from Chairman Powell in the Jackson Hole Symposium, who was much more hawkish than the market expected. And he basically came out and said, we are in for a long, tough fight, and we are not going to back off, and we're going to do more rather than less. And the market, remember, had made a kind of bet that the Fed was going to start backing off because some of the inflation numbers are starting to come down. In fact, we got PCE on Friday, which is the Fed's favorite indicator on inflation, was less than expected. But it didn't really matter because the market was mispriced and it corrected. Friday was a huge, huge down day, selling all day long, and we close on the low. So that's the big story of this week, is that on Friday, it kind of seems like the Fed killed this market rally. So the question is this rally over? We'll get into the charts. We'll talk about that. But I think it's a good possibility that we need to start thinking about this rally may be over. So let's check in on what happened in the economic reports last week. Last week, we had some weak flash services PMI. This is one of the weakest numbers we'd seen in a long time, 44. We got new home sales less than expected. So as you can see, everything's a little bit less. But then we get things like pending home sales, GDP was a little bit better, unemployment claims are still great, and consumer sentiment actually grew a little bit. Again, this is just a mixed picture on economic activity. And Darren and I were just debating earlier about the economy, and we are in the same boat. We have this mixed picture. I mean, Darren, what do you think about the economy here?
Yeah, I think we're at an inflection point. I think we're really at a cusp. And there's a lot of fear out there that I don't think is getting properly reported. I mean, you've got companies that are pulling jobs from their job board because they hadn't been filled. They're not even trying to fill them anymore. They're just splitting up the responsibilities and giving them to other people. So I mean that's one right there. There's just people, especially the middle class, are spending so much more on energy than they were 2 years ago. So they're really making, this isn't a 1 or 2 month transitory thing. This is baked into their budgets now. So they have less disposable income to buy other goods and services. And so the economy could really, I think, go either way right now. And, I'm of the old school. I think if you get 2 negative quarters of GDP growth, I mean, that's just a recession. I think anything else is spinning it and wordsmithing it. So I think we're already in a recession, and there's just a lot of fear out there. Now, you brought up the point that people aren't really losing their jobs anymore, but you see anecdotal evidence of companies are axing non-performing divisions, and or they're saying, hey, prepare for lay off 10% of the workforce. Tesla being a prime example of that. These are successful companies that they're looking to the future and saying, we need to cut some fat so that we can be lean going into this. Now I'm going to disagree with you a little bit. I don't think the Fed killed the rally. I think the rally was already dead, and the Fed just pronounced the diagnosis on Friday, because we'd started to go weak last Friday, and we were down on this Monday. We're just kind of hovering down there, and then then it comes out. I think we were primed to continue to sell since last week. So I think the Fed just made the diagnosis.
Yeah, I would definitely agree with the market was already starting to lose some of its momentum. So let's really dive into the market and take a look at specifically the charts, because this is where I want to be very clear here, is that the charts say everything. Last week, big down week, Dow down 4%, S&P down 4%, the NASDAQ down close to 5%. Oil was up a little bit. Friday was just a nasty day. If you take a look at the charts, you can see that big, nasty red candle there on Friday. Now, we have been talking about these levels of support, and we talked about this band of support between 410 and about 417 on the SPY. And 410 was the bottom there on that. Now, if you take a look back in June, maybe we ticked down to 407, 406, but we closed at 405. Now look, it's a Friday. We closed a tiny bit below support. I'm not ready to call this a full-blown break of support. A lot of times you pierce below support and then you recover back above it. If Monday is a down day, then there's no question that support has been broken. If Monday is an up day and we can bounce back up into the 410 area, that's just a little bit of a pierce, and I wouldn't call that legitimate breaking of support. But if Monday is down, there's no question support has been broken. And then the next area we're looking at is the 50-day moving average right below 400, which is about 1.5% lower than the market is right now. So if Monday is a down day, I think we got 1.5% to go on the downside. Now, I want to stop right here because, as you can tell, Darren and I are both quite bearish. Here's the problem. That's our opinion. A lot of things get into our opinion. Now, we may feel that we're being rational and reasonable people and coming to legitimate decisions. But in the end, everything is going through our biases. So if I am on one side of the political aisle, I'm going to be more pessimistic than someone on the other side of the political aisle. We're looking at the same data, but we feel differently about it based on our biases going into it. If I have a bearish position on right now, I'm much more likely to interpret things that happen to be bearish. And if you had a bullish position on, you're much more likely to interpret things that are bullish. And so I used to trade my opinion when I was a younger trader. And I would dig into that opinion. And it was hard to change my opinion because I didn't want to admit I was wrong. The fact that we're so bearish, this is our opinion. Look at these charts. There is nothing in this chart that is telling you right here, right now, that you should be seriously bearish. We are below the 20-day moving average, above the 50-day moving average. We just broke a little bit below support, but we have a lot of support down here now. Just like we are fighting resistance on the way up, we're going to be fighting support on the way down. So please trade the charts in front of you. Trade the market in front of you, as we always say at Maverick. When it gets more bearish, we'll get more bearish in our trading. But until then, right now, we're just stuck right in the middle of these moving averages. If we come over here to the NASDAQ, we're down into this band of support here, somewhere between 305 and 312. We're just right in this support area now. So the NASDAQ has a little bit more support in these areas. Ultimately, that 50-period moving average should be some support as well. It's too early to get super bearish. I know you may feel like it, but don't. Trade the charts, trade the market in front of you. We did get a pretty good spike in the VIX. VIX is back up to the 26 area. Remember, anything above 30 lately has been kind of the panic. We'll see if we can get up there. If we do get up into the 30s, there's no question that this market is going to go significantly lower. But for right now, it's elevated, and that's about all we can say. So if we look at this week, I want to make sure everyone understands we've been talking over the last 3 to 4 weeks that, hey, we're hitting up into resistance zones. We have to be, a little cautious. Once they break out, then we can get more aggressive until it gets to the next zone. Here we are now on the flip side, where things are now starting to break down. There's a lot of support areas. So it's the same thing. Until we get down to where we can clearly say we're below the 50, support's been broken, and momentum's going, then we can become much more bearish. But until then, I think we really at least have to wait and see what happens at this 50-day moving average. Let me bring this up again. September is seasonally the worst month of the year. The most crashes have happened in the month of September. We have to be aware of that. It doesn't mean it has to happen this year. It may not even happen this year. but you just have to be aware of it as a trader, these seasonality patterns. And so just be aware. I think it's very prudent to be cautious here. Very prudent to be cautious. We do hear more Fed governors. Every single Fed governor that has got up to speak has been hawkish, more hawkish than the market wanted to hear. And when Powell came out and said the same things, the market finally listened this time. Now it's got the market's attention. I think these speeches are probably going to push the market down a little bit more. We'll have to see. So the speeches we talked about, as you can see here on Tuesday, Williams speaks. On Wednesday, Mester speaks. But other than that, it's pretty quiet until Friday. Well, Thursday we do have ISM, manufacturing PMI out of the US. And Friday we have the August jobs reports. Estimates are for 300,000 new jobs, unemployment at 3.5%. These aren't the job numbers we saw last year when we were getting, 500,000. But look, 300,000 jobs is still a very strong number for this economy. So let's really get into where we are here in the market. We are below the 20 moving average. We're above the 50-day moving average. And the 2050 slope is neutral at this point. We were at a +2. We've got to bring this all the way down to a 0. Like I said, it's too early to get very aggressively bearish, but you really have to pull back your bullishness. It's just where the charts are and what it's telling you to do. We've got a -2 on the week. Darren and I both think we do make our way down to that 50-period moving average, and that's going to be the line in the sand. If that 50-day moving average does not hold, then we can start to get much more bearish on that. So let's go through some sectors, Darren.
Yeah, the sectors were kind of interesting to see. It's like, except for two, everything just got moved to the left 2 places. I mean, take a look at that histogram right there. Energy up again, 4.5%. The surprising thing was materials. Well, this is the second best performing sector, but that's a 6.5 point difference between the best performing sector and the second best performing sector. Everything else was looking pretty ugly. Technology, down 5.5%. You've got consumer down almost 5%. Communication services down 4.5%. And these are some major moves. The thing is, they all happened on Friday. Friday was the weirdest day. There was nothing but weak hands. People took a look at what Powell said, and they collectively said, I see no upside for me to hold over the weekend. Why should I put that risk out there? So, the last half hour, it was people just trying to clear their sheets, clear their book, and go into the weekend with as little risk as possible. And you got to see that on every one of the charts. Well, taking a look at utilities here, I'm at a +2 in utilities. It's just everything's been holding up. It's been holding up really good. All the market action we had, even we just touched the 20-period moving average, and we've got a little bit, some support right there. But this is looking pretty good. And so this is one of the better performing sectors, even though this week it didn't show up in the histogram. You can see visually on a chart, this is looking pretty good. So we were at +2 last week. I'm still at +2 this week on utilities. Look at communication services. We were at a 0 last week. I'm at a -1 right now. It was trying to hold in there. It was trying to be the little engine that could, and it couldn't. Friday was the day. It broke the lows, and I think this rapidly turns with the way that communication services has been acting all year. This is going to be one of the situations where a -1 can turn into a -2 or a -3 very, very quickly. I think comm services starts to perform like it did the first 6 months of the year. Real estate, we were at a 0, and we're at a 0 again. Excuse me, we were at a +1 last week, and we're at a 0 this week. This is just kind of wait and see. We're right stuck in the range between the 20 and the 50-period moving average, kind of in that band of support right there. We'll see if we can get a bounce. If it does, great. If not, that 42 level is looking pretty good support that pretty much coincides with that 50-period moving average. This one's, just I'm not bullish and not bearish. Show me what you're going to do. Industrials, these took a pretty big hit, and you can see it was all on Friday. We had a nice, what looked like a bull pullback, and then everything was looking good. You could have just said, hey, +1, +2 on industrials. We gave it all back. This is what you can see, down for a whole sector to be down 3.5% in one single day. That's a lot of damage to be done. So that what was a +2 is now a 0. I want to see that this can just hold up there and maybe make some of those gains back. But that Friday's action right there says this is definitely a risk off. This is definitely a risk off environment here. And healthcare, we've been positive healthcare for so long. Actually, I had to go -1 in healthcare. It just couldn't hold. I think we'd been at a 0. No, we were at a +1 last week. And I just had to go to -1. We thought that it was just going to be this nice gradual move up on good strength, and it all fell apart. I don't think we had one good day in healthcare this last week, and to close on those lows and be so below Tuesday's low for Friday's close. What was looking really good for a long time is starting to look a little bit tarnished. So mildly bearish on healthcare right now. Financials, this is one of the ones we're at a -2 before. Now we're at a 0. Stuck between those moving averages. Let's wait and see what you can do. I think financials, especially with the way interest rates are acting right now, financials I think go down to that 50-period moving average fairly quickly right here. Looking at consumer, this is another one where we were at a +2. This is now firmly a 0. You can see this we've broken through quite a bit of recent support, and then we've got a little bit of room to run before we hit our next support, and the 50-period moving average is right there as well. We have one more day like we did on Friday, and that's there. We're at the 50-period moving average right there. So we're about 3% away from that, and that could come fairly quick, especially if the rest of the market gets sold off. Tech, exact same picture, and tech looks even worse than consumer does. You could make me a case that with the size of the move and the velocity of the move and strength behind the move on Friday, that this is probably in -1 territory. I couldn't disagree with you. The only reason we're at a 0, it's between the 20 and the 50, but it's still above the 50 right now. So once it breaks below that 50, and that's not that's a half a day's trading to get down to that 50-period moving average. Once it breaks below there, I'm happy to be more negative on tech. Materials, though, held in there, looking pretty good, just barely below that 20-period moving average. Had a lot of good strength. The move wasn't as bad in a lot of other things. We're at support, so I'm going to go out on a little bit of a limb here and say I like materials. I think materials is a +1 sector. There's no accounting for taste, so you can see that they're not actively selling materials except for Friday. But they're not actively buying too much as well. So, I'm mildly bullish on materials. Energy, you can see this. Look at Friday's candle. We have Monday, Tuesday, Wednesday, Thursday all up. Friday down 1.17%. If there is ever a sector that said strength like this, it's energy. +2 on energy, and this seems to be bulletproof. We gave up some gains a couple of months ago, but now energy's telling us, hey, we are where it's at. This is the place for us to be. So look at everything in overview. On the left side there, -1, healthcare and communication services. A lot of stuff here at a 0. We got consumer, financials, industrials, real estate, and tech. Those are all at a 0. Those could go either way. Materials, mildly bullish at a +1. Energy and utilities are looking really good. I'd be +2 on both of those sectors. So let's take a look at some possible trades here. So last week in real estate, we were short MPW, and we're glad we had that one because that was down 6.14%. So that trade's looking pretty good right there. This week, we're looking at Sabra Holdings, SBRA. Now, this isn't a bull pullback. Now, we definitely want to wait for confirmation in this market environment. But you can see, Friday's candle didn't look all that bad. It was down about 1.5%, but you've got a lot of good support right there, right at the 15 area. That's 1 day's worth of trading, 2 days worth of trading maybe. Wait to see where it bounces. Wait till you have a candle that is a higher high, a higher low, and then that's your entry point. Just definitely wait for the confirmation. Now, how to play it? I'd play this one just really conservatively. Go out to September monthlies, 15, 16 bull call spread. See right there? That's a pretty whippy trade. This is assuming that it catches support there at the 15 area. before it confirms. But wherever it confirms, that's the trade to go. I wouldn't expect this to. I'm not expecting a whole lot of it out of any bulls in this environment right here. So I think 16 is a very good near-term target. So communication services, last week we were short Match.com, and this is another one that came up pretty well for us. That was down 6.47%. So that one's definitely fell down, and it looks like it has some more downside to it as well. This week we're looking at Verizon. A nice low base here that had a confirmation breakdown last week. That I think it hasn't moved that far below that below the support. So I think you could still get into this. But just a very weak chart. So again, I'd give this one about 2 weeks. Do the 42, 44 bear call spread, and I think that's the way to play it. Last week in healthcare, we had IOVA, and we were sideways to short on that one. That was down 8.33%. If that bounces back, I think we're going to be fine. But it's a little out of our profit area right now. So just keep an eye on it. And that's why we size things for max loss. We're fully ready to take that loss because you can see we've just had 2 really good gains before that. This one may bounce back though. Right now we're looking at Change Healthcare, CHNG. This is a nice high base. This is one of the better looking ones. I know we just went to a -1 on the healthcare sector. Nobody told Change Healthcare. This is looking pretty good. We're in that nice base between the 24.75 and the 25 area. So look at the scaling on this. This is not going to move a whole lot. So go out to October, be long those 2250s, and then short September's 25 against it. I mean, if you wanted to do something even wimpier, you could do an October, September 25 horizontal spread, and then you'll move up into that area right there. So remember, a horizontal spread, we don't use a whole lot. It looks like with 25 being the center point right there, that's a good time. That's a good time play as well. So you're gonna move up. You're gonna pull that premium in from that September 25. You're gonna be long that October 25 as well. If when September expiration comes down, you're at 25 or slightly above or below it, that's great. You still got that October long call that you can have as well, but they're just at the same strike.
Last week in industrials, we took a trade on Boeing, BA, and it was actually up for the week, up 1% for the week. Ooh, big move on Boeing. But look, that's when you found the right trade, is when the market goes to hell and your bullish ones hold in. Maybe it didn't go up 3, 4, 5% like we wanted, but it holds in 1%. That's telling you you're in the right spot. This week, we're taking a look at a short on Southwest Airlines. So as you can see here, we came up, and when we came up above the 50-day moving average in July, we barely got up above it, and then it fell back down. And then we barely got back above it again, fell back down. Notice that this stock was weak all during the time that the market was rallying. Remember, we've rallied all the way through August, and this one hasn't been able to rally. So we like to identify the things that didn't rally, were weak when the market was strong, because now when the market is weak, these things really fall apart. So we've got this support here. I'm looking for a target all the way down to 36 and just a really simple 36-38 bear call spread. So I'm playing it in between here. I'm probably going to get about $1.20 in a credit. Tells me I got 80 cents of risk. Again, 2 weeks out, hold this thing to expiration. And if we get weakness in the market, this is going to be a nice payoff on LUV. Last week in financials. Now, we've played financials sideways for about the last 3 or 4 weeks. We did a butterfly on Visa that was nice. We did a butterfly last week on US Bank Corp that was nice. And this week, here we are. We're going to do another sideways play. This is on Capital One Financial. So basically, we're looking at this thing, okay, this is really trading between the 105, 115 area. Let's use that as our target. So we're looking at the 100, 110, 120 call or put butterfly or iron butterfly, it doesn't matter. We think that's about the right range. Now, let's talk about how this thing probably moves. Darren and I are both at -2s for the week next week. If that is the case, then this Capital One is likely to move down closer to the 105 area. If you're going to be short term on this, I think you need to do the 100, 105, 110 targeted butterfly. So if you're only going to go out a week, I think you play it more bearish than true neutral. If you want to go out 2 weeks with the September 9th, I think then you want to be more true neutral on this with the 100, 110, 120 butterfly. Capital One sideways.
Yeah, consumer last week we were long General Mills, and this is one of the ones that was down 2.12%. Again, I mean, this is just like if the rest of the market's down 3, 4, 5%, and this is only down 2, that is by definition a strong stock. So I'm going to hold on to this one. If it turns out to be a loss, it turns out to be a loss. But I think if we get any type of bounce, then General Mills goes out there. It goes up. This week we're looking at ConAgra, CAG. And this has been a nice pullback. Pulled right back. It's still above the 20-period moving average. We're at support right now. It was one day. Everything else was looking good up until Friday. So this is a nice high base. We've got a little bit to clear out of the 35 area. But, this is one of the ones, go out to October and get that 33, buy that 33 call, and then short September 2nd's 35 against it. A nice little short diagonal. See where it goes. This is one of those ones that is probably going to bounce back pretty good. And technology, last week we were short SONO. And that performed nicely for us. It was down 5.5%. So kind of in line with the rest of the tech sector, but still looks pretty good. This week we're looking at Ring Doorbell (RNG), and this is a low base, and you can tell that people. I mean, these were the rage several years ago, but you can tell that with nobody going to visit anyone's house, the only thing people are using these Ring doorbells for is to find out when Amazon delivers their package. So there's not as much demand for these anymore. So what we're looking at here, you could play it very conservatively and go and do the September 9th. Give yourself 2 weeks, 40-44 bear call spread. If you want to get a little more aggressive, if you think the market's got some more downside to it, go out to September 30th and take those 46 puts. I have some nice delta in there. Give yourself enough time to make it work. I think you're going to be paid out either way. The Ring doorbell is not looking very good.
And Darren, I just love this chart that you pulled up because, again, this is another stock that while the market was rallying off the bottom, could not get off its butt. Just could not. No one wanted it. Even when things were good, even things like Peloton were going up. Not this one. And then the second there's a whiff of weakness in the market, it tumbles. I really like those just straight long puts here on this one, Darren.
Yeah, we don't do unhedged long calls, long puts that often, but when the market conditions present themselves to do it, absolutely. This is one of those ones where you get that delta working for you. You've got that delta working for you. If you're deep in the money enough, then time decay is not too much of an issue for you, and you could ride these things for 5, 6, 7, 10 points. So I definitely like this one on the short side.
Let's jump over to materials. Materials last week we had a BHP Billiton on a sideways. It was up about 3.7%, so it's kind of tickling the upper edge of our profit window. We've got another week on this one, so if it comes down a little bit, it'll end up being a pretty nice trade. This week, Newmont Mining. Now, I have been waiting for Newmont Mining. It had a bad earnings report back here. This was what the big tumble was. And I remember watching it, and I watched that it could not rally. It just could not rally to save its life. Now, remember, this is all in a period of time where the market rallied 15, 16%, and this one could not go up to save its life. It broke down and was saved a little bit, but then boom, we turned here. So this one, I'm finally ready to go short on this one. Same thing here. You want to be conservative? Play the September 9th 40-45. That's not all that conservative of a trade. That's a $5 spread on a $40 stock. That's actually a pretty nice trade. Probably get in $3.20 in the credit, $1.80 of risk. But I know I'm looking to be a little bit more aggressive on this one. I do think that the Fed raising interest rates aggressively is not good for gold. And the gold miners and silver miners have not performed well at all, and they did terribly on Friday. So I like this one. I think it's going below 40. I got a target of about 37 on this one on Newmont Mining. And in the last 2 weeks, we've Also been playing energy more sideways. As you know, we've had that big pullback and started to churn around a little bit. Last week we had Patterson Energy sideways. It was up 4%. So again, tickling the upper end of our profit window, but still just fine, just fine. We're going to stay with that same theme this week. And again, look at another slightly bullish butterfly in the energy sector. This is NOV, old National Oil Well Varco, just called NOV now. But we're looking at these ranges here. We're saying, okay, we feel pretty confident that over the next week or two, we're probably going to be in this range. Look, if it goes up above 20, it's going to be a loss. If it goes down significantly below 18, it's going to be a loss as well. But the play is really to look for that September 16th, 17, 19, 21 butterfly on NOV. That wraps up the trades we have for you. If you're a Maverick trader, jump onto our website, log in, and let's go to the forum and let's get a good bunch of discussions going on with trade setups to where we're all helping each other make a nice profit this month. So to wrap this up, the market has to deal with a more aggressive Fed. As Darren said earlier, the Fed's been pretty aggressive the whole time. The market just didn't believe him. The market believes him now. So all the people that bought because they thought the Fed was going to back off, they have to be rethinking all of their positions and what the Fed funds rate is actually going to do. So couple that with going into September, which is, again, it's the weakest month of the year, the month where the most crashes have happened. I think you have to be cautious. You cannot be bearish yet. It's too early to be bearish. But if you're bullish, you've got to be pulling it back. You've got to be dialing it back and being more conservative. Remember, during the year, we have runs and falls, and we have periods of time where it's easy and periods of times where it's difficult. I think this is one of those periods of time where you just want to wait for like a week or two. And after that week or two, I think it's going to be easier. If we break down below the 50, then I think you just go short and have a really great September, October until we bounce. If we don't fall down, I think the market is probably going to claw its way back up to that 200-day moving average and put some pressure on it again. I just don't think you can really call what's going to happen right here, right now, when the market is trapped between two moving averages. So let's just be cautious. Let's understand that this could be an inflection point. Let's wait for confirmation. And then when we get that confirmation, we're going to jump on that and squeeze as much money out as we can of it. This week, lots of content coming out. As always, we're going to be meeting live on Wednesday. Joe's going to be taking you through the midweek trading room. And then we'll see you next week. Thanks for coming. Goodbye, everyone.
Good trading, everyone.